Ben Rabidoux is back. He was pretty much right about everything he said when he was on the show at the start of the pandemic. And today I want to ask him about what's real and what's pure fantasy with respect to the numbers. And it all starts right now.
This is Debt Free in 30. Here's your host, Doug Hoyes.
Ben Rabidoux, welcome back. How are you doing today?
Good. Doug, how are you doing?
I am doing well. So you run North Cove Advisors, which specializes in information you won't hear anywhere else. That's how I'm summarizing what you do. And you were on the podcast in April 2020. That was a world ago, right at the start of the pandemic. It was show number 292, and you had some very interesting predictions about real estate, rents, GDP, what the banks would do, HELOCs, and so on. The vast majority of what you said, I think, was pretty much bang on. A bunch of it did get a lot of press and feedback and whatnot. So do you want to start with any comments on what you said back then, where you were right, where you were wrong, and what has happened since?
Sure. Well, excuse me. I think you're being generous. When you said I got most things bang on. This was such a bizarre recession in Canada, in that we had this enormous decline in GDP, a record hit to the labor force, and yet you had all of these industries like housing boom. You had, as you would know, insolvencies plunge. All the things that you would least expect to see in an enormous economic shock like that. So I certainly didn't get all of the predictions right. Now, we did say at the beginning there was an enormous amount of uncertainty, because so much of how this would play out would depend on two things. One being the course of the virus itself, and then the other being the magnitude of the fiscal and monetary response. And so one of the predictions I said that I think got a lot of press was, I said, I think there's a chance that you would see banks start really pulling back on home equity lines of credit, barring some significant intervention from the feds to sort of stabilize housing. And what we saw shortly after that is you started to see some underwriting changes at some of the banks, where they were saying, okay, if you're buying an investment property, you can no longer use borrowed down payments. And to me, that was a signal that they were getting somewhat nervous. But of course, fast forward a month, and you had this enormous injection of liquidity from the government and the central banks. And housing more or less stabilized. The economy, it still took a big hit, but the government really supported a lot of the incomes, and that sort of went away. And now you fast forward to the end of the year, and it's very much the opposite, where housing is surging and is setting up for a very strong 2021. So I'd say that one was temporarily right, and then very wrong, right? But outside of that, I think some of the other comments on what might happen with rents and the broader economy were as right as they could be given the circumstances.
Yeah, and the beauty of doing this podcast is I can just tell everyone that all your predictions were bang on. And I mean, who's going to go back and listen to episode number 292?
I appreciate it. Thank you.
And anybody who watched my year-end podcast will know that my predictions were totally wrong too. So now you mentioned a record hit to the labor force. So why don't we start there? Because I actually did some show prep. I did some research. And what I found was that for the month of December 2020, and for everybody watching, we are recording this on January the 11th, 2021. So the month of December, the unemployment rate in Canada was 8.6%. The labor underutilization rate, which is people who are unemployed or want to find a job but aren't looking for one, or they're employed but they're working less than half their usual hours, probably due to COVID, was 36% in April at the height of the first lockdown, and it was about 17% in December, which is still huge. And I assume that when we get the January numbers, it'll probably be even worse, because here in Ontario, we're all back in lockdown again. Your kids are home from school. They're all doing the remote learning. Everybody's in the same situation. So that is quite clearly bad news. And yet, you talked about a bunch of different factors. Why don't we start with the savings rate, which was around 2% before the pandemic. It spiked to almost 28% in the second quarter, and then eased off to about 15% in the third quarter, which would be, around September. Yeah. How is it possible that nobody's working, nobody has a job, nobody has any income, and yet the savings rate's going way up?
Well, before I get to that, let me actually comment on what's happening with the labor force. So, one of the interesting dynamics in the job market is that we're seeing, you hear this talk about a K-shaped recovery. And the idea there is that There was a hit to the labor force. The employment came down, but really what it was a story of the lower income tiers getting hit hardest, right? So accommodation and food services was a big one, right? Retail. And so you saw those industries get hit very hard. If you are a professional, chances are you're unaffected. You're able to work from home. And so you had this story of the economy doing fairly well. That in part helps explain why incomes have held up as well as they have. But really the big story is that there's an enormous transfer from governments to households. In fact, we saw by far the largest transfer in history in Q2. And so, the crazy thing is the magnitude of the transfer offset lost labor income by a factor of 3, right? So in other words, for every dollar that people had lost in labor income due to the shutdowns, the government replaced it with $3. So it was overkill to the extreme. Now, again, we talked earlier, I think last time we talked about this idea that you don't criticize battlefield surgery and that, it's a crisis. You have to do something, right? And they rolled out very aggressive income support measures. And frankly, thank God they did, because the economy it was staring into an abyss, right? But I still think, to your point, when we're talking about the underutilization of the labor force, if you look at what's happening in the labor market right now, there's still, I think, an underappreciated shock that's happening. So, for example, the unemployment numbers get all the headlines, right? But what's not captured within that is people who are not in the labor force but want to work. So we call these often discouraged workers. If you're not actively looking for a job, you're not technically unemployed. It's sort of a weird sort of definitional issue there. So if you include those people and you include people who are technically employed but are working 0 hours, and you look at how much that's changed in the past year, we still have 1 million more people in this country today that are unemployed or employed but working 0 hours or not in the labor force but still wanting to work. 1 million more of those people today than last year at this time. During the depths of the financial crisis, it only ever got to about 600,000. So, that's an enormous shock, and that's not captured in that headline unemployment rate. The other thing that's a big concern now, and I think it's going to be increasingly an issue as it relates to the labor market, is we're starting to see a lot more permanent layoffs. If you look at the year-over-year change in permanent layoffs, we're about 700,000 up from last year. And again, during the depths of the financial crisis, about 450,000. So we're talking about a way bigger hit. And we're also starting to see much longer duration unemployment. So if you look at the share of people who have been unemployed, the share of the labor force that have been unemployed for 27 weeks or longer. It's effectively half a year. We're up to 2.5% of the labor force, which that doesn't give you any context, but before the recession, we're at about 0.5%, and during the financial crisis, got up to about 1.5%. So we're, all of those metrics tell us that the labor market is going to be a long time in healing. Right now, you wouldn't know that from looking at housing and some of the stuff that we were talking about earlier, or off camera, I should say. But this is going to be an economy that's a long time healing, a very long time healing.
So. There's a whole bunch to unpack there. First of all, transfers from governments to households were 3 times as much as the lost labor income. So you said I lost $1 in labor income, but I got $3 from the government. How is that even possible? Yeah. Like, break it down for me. So I'm a guy who worked as a server in a restaurant and I was making $2,000 a month while I got served, which was $2,000 a month. I can sort of see a 1-to-1. I can't see a 3-to-1. Can you explain how that's even possible?
No, well, it's not. It's not even like that. That's not. You can't look at it on a sort of a per person basis, right? Because there are also, there were a lot of transfers back to the government that were delayed, right? So people stopped paying taxes, businesses were able to forego a lot of. So those are transfers that are normally going there and not coming from the government back to you, right? So the flows are being impacted by 2 ways. The government's paying a lot more to the household sector, a lot more through CERB and Canada wage subsidy programs, et cetera. And then in turn, the households are paying less back, right, to the government. And so the net effect ends up being that the flows were about 3 times as much as lost labor income, right, just for that one quarter. Right. So it's a stunning number. And there's lots of ways that you can sort of quantify the extent of the sort of fiscal response, right? But one way is if you look at the change in the deficit in a 1 year period, right? So, let's say you were running a 2% surplus, and then this year you're running a 5% deficit. Well, that's a 7% swing, right, in 1 year. And what we find in Canada is it's almost a 20% swing in the fiscal balance. And that's the largest swing out of any G20 country. And so, the response from the feds has been enormous. And again, look, we can talk later. We can, this is the sort of thing that economists will debate for years and look at, and how much it was warranted and should have been more targeted or whatever. But when you're staring at such an enormous crisis, they had to do something, right? And so in some ways you kind of go, well, kudos to them for at least getting money out the door. But it's abundantly clear that the stimulus was more than what was necessary.
Yeah, and you're right. We're not here to analyze what we had to do in an emergency. If a snake crawls across the floor, I jump up and scream. I don't analyze it. So what I want to look at then is the effects going forward on it. So and those employment numbers you throw out are quite stunning, and I agree with you. It's going to take a long time. And the other point you made there, I think, is you can't look at the averages. Because the person who was at the low end, at the really low end, well, the CERB perhaps replaced what their income was. They were doing fine. The person at the upper end, the office worker, as you say, hey, they're working from home. It's great. They don't have to pay for, transportation to the office. It's all good. It's that person kind of at the low end of the middle who really got hammered. So how then did that affect the savings rate?
Well, it's exactly to your point. It's the people who are still doing fairly well, the more the professionals that were able to sort of transition to the work from home situation. They found themselves in a situation where their employment income was unchanged, but they no longer had a lot of the expenses associated with employment. In many cases, a lot of people, I'm sure we can talk about this later, but a lot of people end up deferring their mortgage more out of precaution than out of necessity. And so you ended up with this sort of temporary increased cash flow. And for many of the people who were affected, when you think about this, like a lot of students, right, that received CERB over the summer, I mean, I would suggest for a lot of them, it more than offset what they would have earned, right? So at the end of the day, you end up with this big, this is not a hypothetical. I mean, this is very real. We saw the savings rate spike to, I think it was 27% in Q2, and it's still about 15% in Q3. But even if you look at things like checkable deposits at chartered banks, right, it's about $90 billion above pre-crisis trend. So there is a ton of liquidity. And I was telling you off camera, that chart looks just like a hockey stick, right? And so, one of the big questions going into 2021 is going to be what happens to all that cash, right? Because that has the potential to really turbocharge the economy in the back half of the year, depending on who's holding it. And that's sort of the big mystery. Maybe we should unpack that right now. So there's an enormous savings. You can almost argue a savings glut. Households are sitting on this record cash pile. And the big question is what's going to happen to that as we head into the new year, right? And to me, the important determinant is going to be, obviously the direction of the virus, right? If we get a vaccine rollout sort of as we're anticipating, then I think you're going to see two things happen to that money, right? If it's being held primarily by higher income households, which I suspect, then you're going to see a lot of that money. Some of it will be blasted into consumption. We know people have delayed vacations, and there's going to be lots of that. I bet you by the fall, you won't be able to book an airplane or a cruise, or it's just going to be jammed, right? But what we know is higher income households tend to have a higher propensity to invest their excess savings rather than consume it. And so, that money will also be invested. And I suspect, one of the things we saw at the end of the year is this like absolutely abrupt turnaround in the condo market in Toronto and Vancouver, where like investors were nowhere to be seen for months. And literally once the vaccine news rolled out, everybody we talked to is just like, yeah, man, like investors came out of nowhere and the market to 180. And I suspect that that's some of that cash sitting on the sideline that people are starting to invest back into real estate, because as we know, Canadians love real estate, right? So that may be something that pushes well into 2021.
Which makes sense. And so we're gonna end with real estate. Before we get there, let's talk about my favorite topic, which is debt. So you've talked about the asset side of the balance sheet. Makes sense. I'm working from home. I've got some extra cash I've been saving. And then when I started to think that things were going to get better, I started, potentially making investments. Talk to me about debt, though. So Stats Canada has this table that reports on household credit, which looks at non-mortgage debt, credit cards, car loans, installment loans. And it was declining from February through May, and then it increased. But that's not because credit cards were going up. That's because car loans, installment loans were going up. Can you break that down for me?
Yeah, that's exactly my read. So what we saw when the pandemic hit is we saw a very sharp deleveraging from households on non-mortgage consumer debt, right? And so, we saw that for a number of months where overall household debt, non-mortgage household debt fell precipitously. And of course, that sort of makes sense, right? Because we just talked about how all these households are sitting on all this excess cash. Well, it doesn't make a lot of sense to have all this cash sitting in a bank checking account earning you 0. whatever percent while you're paying 20% on a credit card. Right? So obviously a lot of households were going, well, this makes a lot more sense to just pay off this credit card. And so we saw this very steep decline in credit card balances, like stunning decline actually. Now that's sort of started to stabilize, but really what's pushing the consumer debt levels up now is more on the secured debt. So things like auto loans, right? And one of the trends that we're seeing is that nobody wants to get on public transit right now, right? Even if you could, nobody wants to. And they may not want to for a while. And so a lot of people are looking for used vehicles. We've seen that used vehicle prices, they initially softened when the pandemic first hit, and then they just did a complete U-turn, and they're just blasting higher right now. So it's actually a great time to be selling a used vehicle, not so much to be trying to buy one. And so I suspect what you're seeing is a lot of secured lending as households are looking to, scoop up autos and stuff like that to not have to sit on the bus or on the train, right? So that's happening. Now, conversely, if you look at the mortgage side of things, mortgage balances are absolutely exploding right now. So, I look at mortgage flows, net mortgage flows as a share of GDP, which sort of gives you a sense of what's happening in terms of like purchase volumes plus refinance volumes. And, they're at a 10-year high. You're talking about the equivalent of about 4.5% of GDP in the latest quarter. And you talk to any mortgage broker, and then you talk to Ron Butler, these guys are just dying with volume right now. Like they're just getting swamped. So on both the refinance, on the new purchase end. So there's a huge demand for housing. There's a ton of mortgage debt that's flowing right now, and a lot of that's being driven, of course, by these record low rates, which I know we can talk about that as well. But I think that's going to persist as well. What we're seeing right now is the Bank of Canada is doing some very targeted asset purchases. So they are out there actively buying bonds on the secondary market. And when you look at the composition of their balance sheet, they're disproportionately buying the kind of 3 to 5 year maturities, right? And the reason that's important is because the most common mortgage rate in Canada is the 5-year fixed mortgage, as you know. And what determines the rate that you get on the 5-year mortgage is the 5-year bond yield. And the dynamics we can get into, but bottom line is, if you see 5-year bond yields rising, fixed rates are going to rise as well, more often than not. And so the Bank of Canada is out there actively suppressing that 5-year interest rate. And so, you throw all that in the pot, and you end up with just this incredible boom in mortgage credit right now.
Yeah, and it looks to me like when you are comparing mortgages to GDP, when I look at just the residential mortgage balance, it just keeps going up and up and up and up and up. Like there doesn't seem to be any hiccups at all.
Yeah, well, we're at a new high on that. So I was comparing the flow, so new mortgage flow. So how much new mortgages are being are being taken on, and if you look at that as sort of a share of, not as a share of GDP, but relative to GDP, you can sort of see the trend over time, and it shows you where you get these sort of housing booms and busts where it goes up and down. But my point is, it's very, very high right now. But if you just compare outstanding household debt to GDP, it's at a record high by a substantial margin. right? And so, there's a lot of debt out there, but it's also never been easier to carry that debt because of low rates and because of the fact that a lot of households are paying off the most expensive debt right now.
Right. And you're right. It's not the amount of debt that matters. It's can I carry it? If interest rates are low, then I can. So what was the impact of all the mortgage deferrals on this whole story?
Well, that was an interesting story. So if you remember back to the summer, I think in July, mortgage deferrals peaked, and they peaked at almost 800,000, which in context, that's about 16% of all mortgages outstanding. Now, what's interesting is during the depths of the financial crisis in 2008, 2009, mortgage deferrals in Canada, sorry, not mortgage deferrals, mortgage delinquencies. So the share of mortgages that weren't being paid reached about 0.5%, so 0.5%. So here we were looking at 16% of mortgages that were being deferred, which is obviously, multiples what we saw during the financial crisis. And so there were some very real concerns about, what that could lead to when people had to start repaying that. There was, of course, this talk about a mortgage deferral cliff. We knew from the beginning that there was some portion of these deferrals that were done out of sort of convenience or out of precaution as opposed to out of necessity. We didn't know what share that was. Now, it turns out it was a lot, right? Because what we find today is the share of mortgages under in deferral are down to less than 1% from 16% at the high. And I made the case that, at this point, it's safe to say that the mortgage deferral cliff is just a complete, nothing burger in that, if you looked at the 45,000 mortgages that were still in deferral in November, if instead all 45,000 of those were, let's say, repossessed and listed for sale in November when those deferrals were reported, there would still have been fewer homes for sale nationally than in November of 2019. Right. So the housing market is so tight right now that even if the people that are currently deferred on their mortgage were instead to list those for sale at once, it just wouldn't have a meaningful effect on the market. So it's safe to say that that's been just a whole lot of nothing. And
so you don't expect any major crashes in the real estate market this week?
Far from it. I think the data that I'm looking at is one of the interesting things we saw as we head into the COVID lockdowns is there was a dramatic reduction in inventory. Right? Obviously, it makes sense. People wanted to pull their homes off the market. In many cases, you couldn't have open houses, but even if you could, who wants strangers walking through their house in the middle of a pandemic, right? And so you saw inventory fell dramatically, and it never really came back. And here we are at the end of the year. Inventory is at 20-year lows across Canada, 20-year lows. Right? There's just nothing for sale. And so it's very difficult to see any meaningful weakness in the housing market until you get supply really start to build. And that's just not going to be a story for the spring. I think it's going to be far from it. I think we're probably going to see an incredibly frothy market into the spring that's going to make 2016 and 2017 possibly look pale by comparison. Now, beyond that is more of an open question. I still think that there's going to be persistent weakness in the rental market. I think population growth is going to take much longer to come back than people expect, and there's a lot of new supply that should start to come online as we move through 2021, and so that should help to take some of the froth off maybe in the back half of the year. But heading into the spring, I think it's going to be just a wild market.
And again, I never like to refer to the real estate market because that's like referring to humanity. Well, everybody's different. Is it true that the condo market in downtown Toronto is different than the standalone housing market in, the 905 outside the city? Because it makes sense to me that I don't want to live in a 500 square foot condo in downtown Toronto so I can walk to work when I'm working from home, but I definitely want to live out in the boonies because if I can work from home now, why not? Is there a difference between those markets?
Yeah, of course. Yeah, of course there is. So a couple points on that. One is when I look across the country and I look at all the major cities, there's really nowhere that has this enormous supply imbalance right now. Even the closest would be the prairies, especially Alberta and Saskatchewan. And even there, inventory is back to basically 10-year lows. So there's nowhere that's seeing this dramatic supply imbalance. Now, what I would say is if there's a supply-demand balance anywhere, it's in the downtown condo markets, to your point, because there has been such a reduced demand for rentals because of what we've seen with population growth and with sort of an exodus out of the downtown cores. But even on that point, what was interesting is December saw record condo sales in Toronto and Vancouver, and by a substantial margin. And so in both of those cities, the inventory is still quite elevated, like very elevated. In the case of Toronto, I think condo inventory is up about 150% year over year, although it's off a relatively low base. But what was interesting to me is in December, we saw the single largest monthly decline in active inventory for condos in at least 20 years, probably ever. And so even there's emerging signs that market's moving back into balance. Now, the question there is, if the rental market doesn't rebound strongly, will there still be such demand for condo investors? Because this is really investor-driven, it's not end-user-driven. Will the demand still be there as we head into kind of later into 2021? That's an open question, because I think the rental market's going to be weak for quite a while. But at this point, you're trying to get into the head of these condo investors that are willing to pay these just ridiculously low cap rates on these condos that don't cash flow at even 70% loan to value. Like, they don't make any economic sense unless you're banking on strong price appreciation or a very strong rebound in the rental market. So I would have said that's a terrible, sort of crazy to be making right now. But if people can make it, they're going to make it, right? And so it's hard to get inside of their head. But we're definitely seeing a rebound. So who knows?
Yeah, you can't argue with that. And you were the one who pointed this out to me in our last podcast about immigration, which I don't know if I'm quoting you correctly, but something along the lines of, immigration kind of drives the real estate market. And when I look at the numbers, the peak for new permanent residents in Canada was 36,000 in the month of July 2019. In April of 2020, it was 4,000. And the last numbers I could find were for September and October of 2020, where it was around 15,000 per month. So, clearly less.
Yeah, if you step back, Doug, I know where you're going. Yeah, I know where you're going with that. So if you take a step back and look more holistically at what drives population growth, so you've got sort of three main components. Right? You've got your natural increase. So that's people that are here that are making new people, right? And that's at a record low. So we're making the fewest new Canadians that we've ever made. And so, then the balance falls on immigration. We sort of know that intuitively. But within the immigration bucket, you've got two important buckets. One is the permanent resident bucket, which is what gets all the attention. That's like, when you hear the government talk about immigration targets of 400,000 in 2022 and all this stuff. That's what they're talking about, permanent residents. But then you've also got this third bucket, which is non-permanent residents, work permit holders, foreign students, et cetera. So the important bucket is this non-permanent resident bucket, which is kind of the third bucket we were talking about. And the important point there is that those are cohorts that are what we call pro-cyclical. So as the economy is strong, it attracts more foreign students, it attracts more foreign workers, for example, because if you can't meet the labor market needs domestically, you have to bring in foreign workers, right? But then the opposite happens when you go through this sort of economic shock, and you actually end up with significant outflows of that cohort. And so what we saw in the most recent quarter is we saw a record low in population growth nominally in Canada. And in fact, if you look at Ontario, the number actually declined for the first time on record. And again, all of that was driven by these massive outflows in the non-permanent resident cohort, which is exactly what I've been warning about for a number of years, that when we hit a recession, population growth is going to be much more volatile than people think, because no one's appreciating how big a driver of population growth this non-permanent resident cohort had become. And that's the reason why I think it's going to be weak into 2021 as well. Even when the borders reopen and we start bringing in more permanent residents, we're not going to get back to pre-crisis levels. You're just not, because that tailwind from very strong non-permanent resident growth is not going to be there, right? So it's going to take a long time to get back to that, because you need to get the labor market back to the sort of strength that it was pre-crisis, so that there's such demand for foreign workers, right? And we're not going to be there for years. So I think that, I think that's going to be one thing that's going to weigh on housing demand. Not that you'd know it right now, but at some point, those sorts of dynamics have to matter. You're seeing it in the rental market, to be fair. That's really what's blowing out the rental market right now. And that's one of the reasons I think the rental market will stay weak for a while.
Yeah, and this is exactly the reason I wanted to have you on, because when I watch the news, well, I don't actually watch the news. That would drive me nuts. But if I was somebody who watched the news, they're not reporting on the, non-permanent resident immigration stats every day. They tell us the price of Bitcoin every day, but hey, these are the real numbers we need to see, and they're not doing that. So, and I totally agree with you in terms of rent. I talk to all my clients who are in Toronto, and I'm getting calls literally every day from them saying, yeah, my lease is up, and I was paying $2,000 a month, but now I found a place for $1,800, for $1,700, for $1,600. So that is certainly tamping down. And I agree, if condo rental rates are going down, then how can prices long-term be going up, or in the short term or the medium term? So I guess what you're saying is we're in a bit of there's many different factors happening here. Interest rates are low. We got cash on the sidelines, so that's putting some money into the market. But on the other hand, there are fewer people living there in certain segments, so that's putting downward pressure on prices. We got to see how it all shakes out, is what it comes down to.
Yeah, I would say, though, that the spring is almost certainly going to be extremely hot just based on inventory trends. It's really hard to see a scenario where we get so much inventory come to market in the next couple of months that it takes the froth off. And so I think you're going to see a really wild spring market almost either way. Beyond that is more of an open question. And I think the segment to watch is the condo segment, to see if you get some fatigue from these investors that are obviously expecting a very sharp rebound in the rental market. Otherwise, these prices make no sense. They just make no sense. You're cash flow negative at these huge down payments. It's just hard to see how that's a good investment. But if they're right, and the vaccines roll out and population growth surges back to the highs, and the economy rebounds, and everybody moves back in downtown Toronto, maybe it's a brilliant investment. But I don't have that view at this point.
Yeah, well, condos have been cash flow negative for a decade. Like, that's not new.
But you can actually see one of the things I do is I track the cash flow trends. So if you look at rental rates and then you adjust them for the change in interest rates, right? Because you could say, okay, well, rental rates are falling, but interest rates are also falling. And so what's the net effect, right? Can you hear that in the background? My son is singing out in the kitchen.
I can't hear it at all.
Okay, you're not picking that up? Okay.
We'll put the camera on him at the end, though, so we can see.
Oh, man, this whole learning from home thing. But my point was, even adjusting for falling interest rates, the cash flows are absolutely blowing out. They're getting dramatically worse, right? Because the rental rates have fallen so much.
Yeah, no, I hear you. So people watching this podcast are ordinary people. They're not necessarily, investors who have 47 different condos out there. What should the ordinary person be worried about or not worried about over the next, let's say, 6 months, first half of 2021? Anything in particular?
The one thing I'm just starting to think more about is whether or not we're heading back into more of an inflationary future. Not like a 1970s style double-digit inflation, but whether we're going to start seeing just a new inflationary cycle, because we've seen it's been persistent disinflation for years, right? We really haven't seen, I know you talk to some people and say, well, of course there's inflation, look at my grocery bill or look at the cost of housing or whatever, right? But really overall, inflation's been very tepid no matter how you choose to measure it. And I think you're starting to see a case to be made that we're going to move into more of an inflationary environment, especially if we get this rebound in demand as the vaccines roll out. And especially if that demand happens to coincide with, just a persistent supply shock because a lot of supply chains are still disrupted. I think you could make the case that we'll start seeing more inflation. So, that could start to affect consumers, right? You could start feeling that on your grocery bill. If you look at the cost of agricultural commodity, they've absolutely spiked in the last few months. So that's one thing to watch, because you could end up in a situation where a lot of that excess cash that people have been saving, it starts to get sapped away because just living expenses start to rise a little more. So that's maybe one thing to watch. Outside of that, I just say, just do everything you can to keep your job and be employable and improve your skills, because I feel like this labor market's going to be a weak one for a while.
Well, we covered a huge amount of ground there, and the world will keep changing. I did not pin you down and ask you for your predictions on gold, Bitcoin, and all those other wacky things out there. So you dodged the bullet on that one. So for people who want to hear your thoughts, I think the best way to do that is probably on Twitter. Ben Rabidoux, is that the best thing? You leave your account open. You only block the really crazy people, I assume. So, and you do post a lot of stuff there. So I will put the link to that in the show notes. Ben Rabidoux, BenRabidoux. Did I spell that correctly there?
You got it. Yep, you got it. And we do have a research service. It's primarily for high net worth institutions, but if people are interested, they're certainly welcome to reach out. I post, a small fraction of the sort of stuff that I put in my typical client notes. So, and there's something that's of interest, and they're always welcome to reach out. And
there's a link in your Twitter profile to your website at North Coast, so people can track you down there. So we will have them do that. Ben, thank you very much for being here today.
My pleasure, Doug. Take care.
Excellent. Thank you very much. That is our show for today. Please like and subscribe on YouTube and your favorite podcasting apps. I've got links to all the data we talked about today in the show notes on YouTube and a link to Ben's Twitter and his website. So thanks for listening and watching. Until next week, I'm Doug Hoyes. That was Debt Free in 30.